Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 7th of April. Let's dive into the week's top market news. European equities rally on geopolitical optimism while energy shocks cloud macroeconomic outlook. The pan-European equity markets experienced a robust performance recently, with the Stoxx Europe 600 index ending the week up 3.92% in local currency terms, even as regional markets paused for the Good Friday holiday. This positive momentum was heavily driven by improving investor sentiment, fueled by hopes that the ongoing conflict in the Middle East might be resolved more quickly than initially feared. Major national indices across the continent reflected this wave of optimism. Italy's FTSE/MIB led the regional gains with a striking 5.18% increase, followed by the UK's FTSE 100 index, which climbed 4.70%. Germany's DAX and France's CAC 40 index also posted solid returns, advancing 3.89% and 3.48%, respectively. Despite the exuberance in the equity markets, the macroeconomic landscape remains complex, largely due to the tangible impact of the Middle Eastern conflict on energy prices. The annual rate of inflation in the Eurozone climbed to 2.5% in March, up from 1.9% in the preceding month, marking the highest inflation rate since January 2025. This increase was almost entirely driven by a 4.9% surge in energy costs. Interestingly, this energy-driven spike masked a broader disinflationary trend in other segments of the economy, as price growth actually decelerated across services, non-energy industrial goods, and food, alcohol, and tobacco. However, the energy shock is already taking a toll on growth expectations. Citing the geopolitical disruption to energy markets, a group of Germany's leading economic institutes, including the IFO Institute, significantly downgraded their joint forecast for the country's 2026 gross domestic product, slashing projected growth from 1.3% to just 0.6%. Industrial performance across Europe also revealed stark regional divergences during the month of March. In Spain, manufacturing activity fell into contraction territory. The S&P Global Spain Manufacturing PMI dropped to 48.7, a decline from the neutral 50.0 mark in February, and well below market expectations of 50.4. The United Kingdom experienced a similar cooling, with the S&P Global UK Manufacturing PMI revised downward to 51.0 from a preliminary estimate of 51.4, down from 51.7 in February. Although UK manufacturing output contracted for the first time in 6 months, underlying metrics such as new orders and supplier delivery times continued to show improvement. Conversely, Sweden stood out with a surging industrial sector. The Swedbank Manufacturing PMI for Sweden jumped to 56.3, its highest level since March 2022, bolstered by higher employment and robust inventory purchases. Swedish corporate optimism remains elevated, with production plans for the next 6 months registering a strong 67.8. On the consumer and real estate fronts, domestic data points highlight pockets of economic resilience. In Switzerland, the Federal Statistical Office reported that retail sales rose by 0.9% in real terms year-on-year in February. This was driven entirely by a 2.8% expansion in non-food sector sales, which successfully offset a 1.1% decline in the sales of food, drinks, and tobacco. Meanwhile, the UK housing market demonstrated accelerating momentum in March. According to the nationwide house price index, monthly house prices rose 2.2% year-on-year, marking a significant acceleration from the 1.0% growth recorded in February. Now our insight into alternative markets. The new paradigm of family offices. The strategic transition towards private equity. The wealth management landscape for ultra-high net worth individuals, UNWI, is undergoing a profound structural transformation. While family office models have historically been conservatively anchored to public equity markets and fixed income, a massive rotation toward private markets is currently underway. This strategic reallocation, which specifically favors private equity, PE, venture capital, VC, and the real estate sector, is largely driven by the growing and persistent volatility of publicly traded markets. Consequently, investors are increasingly seeking the perceived stability and the illiquidity premium offered by private assets. Furthermore, the historical long-term outperformance of private equity relative to public equities presents a highly rational value proposition for the multi-generational investment horizons that characterize the management of substantial wealth. Empirical data unequivocally confirm this prevailing market trend. According to evidence from the UBS Global Family Office Report, the average family office currently allocates an estimated 20% to 22% of its total portfolio to private equity. This capital is deployed through a dual approach, maintaining traditional commitments to institutional funds alongside a growing proportion of direct investments in private companies. This direct investment strategy is gaining considerable strategic traction because it allows large families to bypass the traditional fee structures of funds, exercise greater operational and governance control, and closely align their capital with their personal values or historical entrepreneurial DNA. To effectively differentiate their portfolios and optimize asset allocation, large estates must adopt a rigorous, institutionalized approach to private markets. This process entails a targeted increase in exposure to highly specialized private equity funds capable of capturing structural megatrends in sectors such as technology, healthcare, or sustainability-oriented (ESG) investments. However, the inherent lack of informational transparency in unlisted markets demands superior risk management capabilities. Successful family offices are therefore building robust internal teams of analysts or forging partnerships with specialized advisors to conduct highly rigorous due diligence processes. Concurrently, risk mitigation is achieved through meticulous diversification across vintages, the launch year of the investments, geographic regions, and stages of corporate development, effectively balancing risk exposures from venture capital and growth equity through to traditional buyouts. Through this sophisticated private equity investment architecture, family offices not only maximize the efficiency of their risk/return profiles, but also ensure that value creation remains steadfastly aligned with their long-term wealth preservation objectives.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.